If you
Okay.
want to kick us
Walt, I've
off,
never actually, I just have to comment, I've never seen you so casual. Like,
not without a sweater vest.
yeah. Yeah, it's good. I like the look. It's good.
Well, thank you.
Hey, I just want to introduce myself. I'm Tracy with Fidelity, and my team is on here. You just can't see them, but we've got Sammy Lee and Lori Phelps and Kelly Turgison is our assistant county manager, and Serena Payne is our newest sales manager. So they're on here. If any questions come up from this class that you want help with, and um, reach out to me or your sales executive, and they can help you. And also, while I have you guys on here, I wanted to tell you about some of our newest tools. I know a lot of you have heard of Farm In or the In Here app, which is the program that your escrow details get into. If you have any transactions with anyone in the Fidelity family, you can look up your transaction in your In Here program. But now there's a new Farm In Here program that's a branch of that is a really, really amazing farming tool and property profile tool. So we've had a lot of farming tools and we've had property profile tools, and now you can have everything all in one. So just a little just a little bit of information on that. So if you have not heard about this tool, reach out to your sales executive and I can help you or they can help you. And yeah, and anyhow, thank you, Walt. It's been a long time. So I'm excited to see what we've got today.
Been a couple, well, I guess when was the last class? We had been doing classes there every month for a while. We started those back during COVID and did that for a while. And then actually COVID, we did them like weekly for a little bit, didn't we?
Yeah, we did weekly.
Yeah, we did weekly for a little bit. And then, yeah, so, um, yeah, I think our last class was February or March. So
Yeah, exactly. So good.
anyway, thanks for having me. And guys, if you guys don't use Fidelity, honestly, I, I have, we closed through all different title companies, of course. We're taking all different title companies all the time. And Fidelity is the one that I tend to have the smoothest closings with, the easiest closings. That's where I send all my transactions to. Love working with Teresa and her team. I was telling a client yesterday, we're going through a refinance yesterday for this client, and uh, and I said, yeah, Fidelity will reach out to you, Teresa will, or KJ will, and then I just started recounting. I said, yeah, I've had a relationship with Teresa now for 26, 27 years, and so yeah, so relationships just go deep. I mean, they
Yeah.
go deep and they go long, and I can't tell you how much Fidelity's meant to me over the years, and you, Tracy, and everybody there. So thank you, thank you.
Thank you.
All right. So today, this class, what really stemmed this class was a couple of things. Um, Over the last couple of months, I've met with over 25 financial planners. Um, and I started forming this class as I met with those financial planners. And as I really started to see, well, this class was really formed in my mind back during COVID, when we do an annual review with our clients every year, right? So an annual, we call it an annual mortgage review. I'm now changing the name to it to be an annual financial fitness checkup. Reason being is because right now, a lot of people don't really want to do an annual mortgage review because they think that mortgage review is just us reviewing the mortgage and we want to refinance the client. That's really not the case. It's really a financial fitness checkup. Again, like the client yesterday that I met with, um, she hadn't met with her with her mortgage person for 3 years. She didn't even remember who did her loan. She knew the company, and I'm not going to say the company because then you would know who did the loan. But ultimately, she knew the company. But um, and the reality is that she was in an FHA loan and she had mortgage insurance, and she's had mortgage insurance now for 3 years on the FHA loan. Now, those of you that are astute enough will know that, okay, FHA has mortgage insurance the whole life of the loan, right? So, of course, having mortgage insurance on an FHA loan, what's the big deal, right? Well, it's $82 a month that, to this retired couple. Now, there's a caveat to the FHA that most people don't know, and that is if you put 10% down on an FHA loan, you can get rid of your FHA mortgage insurance after a couple of years. So you have to pay on it for 1 to 2 years. After that, you can get rid of it. And the mortgage person never even called to reach out to say, hey, you can actually I can save you $82 a month. And I'm going to tell you that $82 a month right now is a lot to a lot of families. A lot to a lot of families. In fact, there was a recent study that was done that found that, what was it, 94% of families, I think it was. I have to go back to the study. I apologize. I don't have the exact numbers, but it was in the high 80s, low 90s. 94% of families right now, if they were to try to come up with $500, they would fail. They would not be able to do that. So that's really, with AI, the way that AI is coming about these days, I'm seeing a need for all of us. And I'm going to spill part of the whole class right now, but I feel the need to really start to push on the fact that all of us need to be moving to advisors. We're not, we're not real estate agents, we're not loan officers, we're advisors. We need to advise our clients. And there's more ways than one to be able to advise our clients. And that's the only way that we're going to survive through AI. One is using AI. So those of you that aren't using AI, you need to get on the bandwagon. It's coming, it's here, it's not going away. It is right now, AI is not as smart as the smartest person on the face of the earth. That's called AGI or AESI or whatever. But anyway, there's a point where AI will be smarter than the smartest person there on the earth. That was supposed to take 10 years to get there. Now they're saying it's going to happen this year or next year. So the average time for technology to regenerate itself was 7 years, and to be better than the current model. It took about 7 years consistently. So from there, with AI, it's now 7 months. So the way that AI is learning and the way that AI is doing everything, it is sped everything up so fast. You have to get on the bandwagon. You have to learn AI. There's courses you can go to, there's different things you can do, but get learning AI if you haven't been. So that's my bandwagon on AI. Now, with that said, I'm going to say that, and I've said this quote before, that the Strathmore Group did a study and they surveyed 13,000 clients that had closed on a loan, and they had asked specifically on the realtor side, they said, for you that have closed a transaction in the last year, a purchase transaction in the last year, how many of you would work with your previous agent again? 74% said they would. So that's not a super bad number. I mean, there was 26% said, they might, whatever. That doesn't really matter. But 74% said that they would. That's the number that we want to watch. Second question, who was your previous agent? 92% said they had no clue. Within 1 year, they'd forgotten their agent. That is the same on the lending side of business. Whenever I meet with a client, I already know who did their previous loan because I see it on their credit report. I see who they've had loans with in the past, and I know who they currently did their current loan with, because I can just track it back to when it originated, when it's been sold, and whatever. And I look at those things, surprisingly enough. So I always ask clients. Who did, and I word it this specific way because I know exactly how it's going to work out. I ask specifically, who did your previous loan? And they will always come back. I mean, 99 times out of 100, it's with the company's name. And with that, are you guys hearing? Can you hear me okay?
I can.
Sounds like some people are having an echo or something. So, anyway, so my mic's right here. If I need to make it a little closer, let me know. I haven't had any problems with it in the past, but who knows? Anyway, I always ask a client, who did your previous loan? And the reason why I word it that way is because I want to know that they always go to the company. And they'll always say, you know, the company name. And at that point, I always ask, who was your previous loan officer? And again, 99 times out of 100, kind of like on the real estate side with the Strathmore Group, they can never tell me who their previous loan officer was. Now, I believe that that's a serious problem with our industry. And, you know, if there was mortgage malpractice, I believe there's so many loan officers that can be sued for that. You know, why is it acceptable? And it is purely acceptable in our industry to get a person in debt, the most amount of debt that they'll ever be in their entire life, and then never talk to them again. And I'm talking on the loan side, guys, not on the real estate side. So, you know, why is that acceptable? That's just a common thing. It's okay. I don't believe so, and we don't treat our clients like that. So, we do annual financial fitness checkups, where we look into mortgage insurance, we look into insurance, we look into, you know, how much money clients are saving for their goals, and that. And this class really stemmed from those annual checkups, which of course we did. We did all of our clients. We have over 600 clients under management right now. And in 2021-22, we of course met with all of our clients during that period of time to do a fitness checkup. And at that time, I asked my team, out of all of our clients, guys, how many people have at least $200,000 or more in retirement right now? And my team said, maybe 5. And take people that have PERS and you know that out. So PERS is a great thing, but you know, take the state employees out. But ultimately, how many of our clients had $200,000 or more in retirement? And it was about 5. And I said, okay, let's go down to 100,000. How many of our clients have $100,000 or more in retirement? Now, of course, 28 years in the business, guys, I've got clients that are, you know, 20 years old. I've got clients that are 85 years old. So I run the gambit. So the next question was how many have $100,000 or more in retirement? They said maybe 10, at the most 15, out of 600 clients under management. So, so at that time, I kind of waged war on fiscal literacy, everything else, and then started moving more and more to that advisor role, and wanting to teach our clients fiscal literacy, and that. And I found that during that period of time, there's clients that really can't do a lot of things that they want to do. So that's the basis of this course. Is I believe that the rules around money and the rules around real estate have changed. They've been changing since 2008. In fact, some of the slides in this presentation are from a ethics course that I taught. That was a 4-hour ethics course in 2008. And so, I'm going to bring those up at this point. I just felt impressed this morning to bring those up. And so, so I hope that you enjoy this course. Please stay till the end. Well, one, you have to stay till the end. You're being timed right now, whether you know it or not. That's why we have to do a webinar. So we know when you come and when you go. And then I'll track when you go to know if I said something that you guys didn't like. I'm just joking. Anyway, appreciate you guys for being here. So I'm going to share my slide and my slides here, and we're going to start on the course. So again, I really hope that you guys enjoy it. All right, and Tracy, right now I can't see the comments or anything, so if there's anything I need to pay attention to, let me know.
Yep, I'll watch it.
All right. So first, those of you that don't know me, I help people make one of the biggest financial decisions of their lives. I'm not just a mortgage loan officer, I'm a mortgage advisor. I actually have certain certifications as well. Um, and so I'm a certified liability advisor, certified loan officer, and some others as well. So, um, really in helping people make the biggest financial decisions of their lives, I do that without confusion, without pressure, and without bad advice. And most people leave a mortgage conversation more confused than when they started, I've found. So my clients, they leave with complete clarity and being empowered. So that's who I am. I want to share with you guys exactly what the market's doing right now. And when I say right now, this was 9:21 this morning. You probably heard that we have this little, I don't care what you want to call it, conflict, a war. We have an issue with Iran right now, that's going on and has really been fluctuating the markets quite a bit. Before Iran, we were down we were in the high fives, which is where economists had said that we would be. I started locking loans for even some refinances, helping clients in the high fours at that point. So, um, really in March, we touched a resistance level, and this is the 30-year bond chart. The way the 30-year bond chart works is that the lower the yield, so the 99.50, the higher the interest rate. You can see that down this morning we were down 14 basis points, which is a decent market movement anymore. So you can see that in March, well, you can see when the war started and the war of the conflict, again, whatever you want to call it, we started selling off in the bond market. So bonds knew that the conflict would create inflation and would create inflation in oil and energy, which is exactly what it's done. You've seen that in the gas prices go up significantly. So we had a massive sell-off. Immediately, we went from the high fives on a 30-year fixed, 5% down conventional loan to 7%. And that took less than a month to happen. And you'll see here at the 99.50, that's where we were at. We were about 7%. We then started to improve as we had talks with Iran, everything else, and we had ceasefires, and then we didn't have ceasefires. So we hit the resistance level again at about 99.21 right there. We pierced through it one day in May, but we closed above it, which was important because that acts as a resistance level at that point. We then bounced off of it. We started to improve as we went into June. And you can see the big market movements in the red. Those are the days that we've lost significantly. All of the L's that you see on this chart are lock alerts. So that's where we've received a lock alert during the day where we needed to lock. The market was getting bad really fast. You can see then in early July there, we started to hit the resistance level again, bounced off it over a couple of days, and then we're now hitting that resistance level again. So hopefully we will stay at that 99.21. We won't pierce through that. If we do, rates will get worse. We'll probably be hitting 7.25, maybe even 7.5. Now, the thing to remember on this is that those aren't bad rates, guys. Those are rates that the national average for the last 30 years has been 7.74. And so anytime we're below that, we're doing better. However, a call that I had yesterday was one of my past clients saying, hey, I'd like to get a 2% mortgage. I'd like to refinance it. I'd like to get a 2% mortgage, which we had a good laugh because, again, those rates don't exist. They won't exist again for a long time. That was actually a black swan event that created those rates. So, so let me just ask you guys, and how many of you are worried about you're worried more about AI taking your job? AI really isn't the biggest threat. Being replaceable is, and I'm going to say that there's a lot of people that are being replaced or replaceable today. In fact, if I was in school today, high school or college, I would probably change my major to working with AI, or I would go into one of the trades. I mean, honestly, being an electrician, a plumber, any of the trades, HVAC, any of the trades. I mean, I saw nursing, nursing. There's certain states that need 30,000 plus nurses. So it's a lot of the trades. AI will never replace those, but AI will replace a lot of different roles. The one that will never replace ever is an advisor. So being an advisor is where it's going to end up being. Now the agent landscape is shifting, and you guys have probably heard this. In 2023, 49% of realtors closed 0 to 1 loan per or not loan, but transaction purchase or whatever per year. Last year, it was 76% of the agents closed 0 to 1 transaction during the whole year. And so, we had 1.45 million, I think it was, realtors. We had a peak of 2025, 1.6 million realtors throughout the nation. So there's a lot of agents that haven't closed a lot of transactions. Now I'm going to give you guys a stat that is massively important, and it is your sphere. Out of your sphere, if you have 100 people that you know, like, and trust, out of your clients, out of your sphere, whatever, 10% of those people are going to do a transaction this year, or 10% know somebody who's going to do a transaction. So you have 10 transactions right there, and there's a secret path to be able to help them. And I can talk to you one-on-one on that. But ultimately, 10% of any given database, guys, any given database. And I know that by looking at who's on this call, there are some agents that have been in the business a long, long time. You should have a massive database. 10% of your database is going to do a transaction this year, or will know somebody who's doing a transaction this year. So, it's pretty massive, guys. And I have ways to be able to help manage your database and secrets to be able to help with that. So what AI can already do, and it can do better than any of us, guys. Search and filter listings instantly. Draft offers and contracts. I just recently sold my building, and so my office, and I will tell you that I wrote a couple leasing contracts through AI. I just took my leasing contract, dumped it in, and said, here's what I need, here's the verbiage that I need, and boom, it created everything I needed. So AI did it very fast and better. Answer questions 24/7. Run automated property valuations, qualify leads, and manage follow-up. By 2028 to 2030, up to 80% of the tasks typically handled by agents could be automated. So that's industry and analysis 2025. So we're looking at AI being able to do things very, very quickly. I know of a mortgage company right now that closed $156 million of loans last month that were strictly underwritten by AI. No human touched AI, a human put the file in AI, but AI underwrote the file, and they were sold to Fannie Mae and Freddie Mac. $156 million worth of loans. So AI is starting to, and I'll tell you that with some of my underwriters these days, I'll combat their objections through AI. AI can search guidelines faster than I can. And that. So it's a tool that I use so many times per day to help speed things up and look for answers and help to put things together a little bit more succinct and that. It's also a tool that I help to communicate with people too, where I may put an email in there from a client that I really just don't understand what they're saying here, and AI can look at it multiple ways and help me understand a little bit better what the client's looking at. So it's a tool, guys. What AI cannot replace: guide someone through the biggest financial decision of their life. So buying a house, investment property, whatever, is the biggest financial decision of their life. AI can never replace that, guys, ever. Apply human judgment to complex emotional situations. AI is ones and zeros. That's all it is. It is never emotional. and it can never be emotional. So provide hyper-local nuance that algorithms miss. AI lies to you. I'm going to tell you, I have caught Claude and Chat both lying to me multiple times. So it lies. So just having a human to be able to go through that and see. Be the trusted person that clients calls first when it gets complicated. Do real estate transactions get complicated sometimes? I would say yes. AI can't fix those things. So agents are not going away. Some agents will, unfortunately, but the ones that embrace AI and the ones that can really know how to use it within the business to help and create it that make it a tool, they're going to excel, and they are excelling in this business right now faster than anyone can even imagine. So the old rules of retirement, and I'm going to share the why behind this in a minute, but I believe that these rules have changed, guys. And that is, you buy a home, you pay it off early, you save for retirement, and you retire comfortably. This model no longer works for most Americans. In fact, a financial planner that I met with last week has a client that is 73 years old looking for a second job. He can't retire, 73 years old. Now, 73 years old, sometimes you're feeling great and you're doing great. I know some 80, 85-year-olds that are, I mean, they're killing it with life. They are mobile, they're doing great. And my mom, 87, dementia in a retirement home, not doing so great. So, but yeah, so that's the old rules of retirement. And I'll tell you when that happened and when that started. Why the rules have changed. So the median home price has increased significantly, up 48% since 2019. 62% of Americans say buying a home is unrealistic in 2026. And I'm going to say that that could be true for some of Americans. But the reality is that the majority of Americans still to this day don't know that you can do 100% financing. They don't know that you don't have to put 20% down on a house. And 40% of gross income, the typical 2026 buyer spends on housing. So housing has increased to 40% of gross income. And so client's home is their retirement, guys. I'm going to tell you right now, I'm seeing that more and more for clients. There's $14.66 trillion worth of equity in people's homes. That is for Americans 62 and older. Homeowners in their 60s have accumulated $200,000 in equity. Remember, I said that the majority of our clients don't have more than $200,000 in retirement. I will say that the majority of our clients have more than $200,000 worth of equity in their property. The ones that we've been able to help. 65% of homeowners 50 plus would use equity to retire sooner if they could. Reverse mortgages volume has increased 6.23% in 2025. The market is waking up. Only 40% of baby boomers have enough savings to maintain their lifestyle in retirement. So the retirement savings is a crisis in America, and it's real. The savings gap. So the average retirement savings for workers ages 21 to 64 have $1,000 in retirement savings. That's it. So $40,000 is the amount median balance, even with employer savings. 1.26 million is what most Americans think that they need to retire. The reality is that by the year 2043, you're really going to need at least 2.57 million to retire comfortably. And these numbers are from the National Institute of Retirement Security and from Northwestern Mutual's report, and also Goldman Sachs's report in 2025. Paying cash for a house, I've been saying for a long time now, and I believe it is more true now than ever, guys. Paying cash may be the worst financial decision your clients will ever make. Cash tied up in a home can't earn returns in the market. Retirement accounts or other investments. You have opportunity cost where it's tied up in your house, and it's going to lose at that point. Lost tax benefits. You have a liquidity risk, one major repair, health event, or job loss, and they have no cash reserves, but an illiquid asset. I'm going to tell you, we saw that during 2008. 2008, if you lost your job, you had to sell your house. If you didn't have a way to pay your mortgage, you had to sell your house, and you had to sell your house in a market that was decelerating. And so, the values have gone down. And, most people believe that it's safe doing that. I believe it's actually one of the riskiest investments is to pay cash for a house. So a house-rich, cash-poor client is the most common retirement disaster we see. So why, I look at, and I've told you guys this before, so anybody that's worked with me knows this, but I look at why, why do we have in America a philosophy of paying our house off, and paying off really as soon as possible? Why do we sleep better at night with that? And I believe it goes all the way back to the Great Depression. This was actually written back in the 90s, I want to say. I think that's when Rick Edelman wrote this book. But Ordinary People, Extraordinary Wealth. And when he wrote this book, he went all the way back to the Great Depression as to why people believe what they believe. And I think this is an important story. So let me go to the story. So during the Great Depression, excuse me, during the Great Depression, you would buy a house with 20% down, or however much the banks would require at the time. So this is 1929. You walk into a bank. You can only borrow money from a bank. You walk into the bank, and you would say, "Here's my money." They'd say, "Great, here's the loan." The banker would then give you the note and ask you to sign it and tell you at that time that here's the note. He would explain it. He would say, "There's a clause in the note that says we can foreclose upon you for any reason that we need." And so, but we would never foreclose upon you, so don't worry about it, because we make money off of you, because the money that is in other people's savings accounts, and It's a Wonderful Life really, shared this entire story. As you see, It's a Wonderful Life, and George Bailey and the savings and loan and everything. So he breaks down banking to a T, where all of our money that's in savings accounts and everything else is then lent out. It's called arbitrage. And so the bank borrows money from you in your savings account at a whopping 0.5% per year. Unless you're wise, you then get a high yield savings account, which you'll be making around 3 to 4% money right now. And they borrow money from you at that level. They then in turn lend that money out. That's how banking works. And that money, when they lend out, they're going to lend out at 7, 8, 9, 10%. It's in our auto loans, it's in our home equity lines of credit, and all of that. So the banker said, "Don't worry, we will end up, there's no reason why we would foreclose upon you." Well, the Great Depression happened. And in 1929, there were margin calls that happened. When the margin calls happened, there were traders that then had to go into the bank and handle those margin calls because they were buying stock on margin. They would go into the banks, and after a little while, the banks ran out of money. I'm going to say the same thing happened, guys, during COVID. And there was a $1 billion bank bailout that most people don't even know of. That was part of the $6 billion that we ended up, or trillion, or whatever it was, that we ended up, I think it was trillion, if I'm not mistaken. Anyway, there was a bank bailout during COVID. Same thing happened. But during 1929, Where did the banks get their money? They then went to people that had mortgages. And who did they see first? The people that had the most equity. So fast forward to 1940, at that time, the mantra was born. 1929, the mantra was born, pay off your house as fast as possible. 1940 and 50, the mantra was born, retire with Social Security and with a pension. How many companies have a pension these days, guys? Very, very few. And in fact, you look at the Oregon pension, PERS, the amount that employees get these days have lessened significantly. So got a problem there. Now we go to the 80s and the 90s, when the 401ks were created and the IRA 401ks and all of that, where people could save their own money through that path. People really, they don't have the money to be able to save money, because during the 90s and the 2000s and 21 and 20s, you now have the sandwich generation. So you have the younger baby boomers who are paying, and the Gen X population, who are paying for their kids to go to college, which they're paying all of that money. And then they're paying for their parents, who, because the rules of money have changed, don't have enough for retirement. So they're paying to help them pay their mortgages every month, paying for food, paying for medical costs to keep them in the house as long as possible, whatever it may be. But the one thing that's happening is that people are paying their mortgage every month, which is a great thing. But the rules of money during that period of time had changed from paying your mortgage off as fast as possible, retire with Social Security with a pension. Then it was save your own money for Social Security or for your pension, because pensions were going away. So the 401ks were created, the 401k, IRAs were created, Roth IRAs, where you can have pre-tax dollars, and you need to watch retirement, pre-tax, post-tax. So from there, then, people, they're paying their mortgage down. They have a tremendous amount of equity, hence the $14 trillion worth of equity in people's property. But retirements now are significantly low because they haven't been able to save for retirement. So how do they retire? Hence, the guy that's 73 years old looking for a second job. So dismissing the old concepts. Robert Kiyosaki wrote the book Ordinary People, Extraordinary Wealth. I'm sorry, Rick Edelman wrote that book. Robert Kiyosaki wrote Rich Dad, Poor Dad, which is one of my favorite books. And Douglas Andrew wrote Misfortune 101. Today's financial experts advise us how to handle our money according to how we live today, not how our grandparents lived. They're all really important books. And they taught me how wealth is created through a mortgage. So in The Truth About Money, Rick Edelman stated that incorporating home ownership into your financial plan, he said, too often people buy homes in a vacuum without considering how that purchase is going to affect other aspects of their lives. This can be a big mistake, and therefore you must consider that owning a home holds very important implications for the rest of your financial plan. Although a fine goal, owning a home is not the ultimate financial planning goal. And in fact, how we handle issues of homeownership may well determine whether you achieve financial success. Paying cash for a house is the worst financial decision you can make without looking at a true financial plan. So Ordinary People, Extraordinary Wealth, Rick Edelman went on to say, carrying a mortgage doesn't cause you to lose money at all. Just the opposite is true. Carrying a mortgage is actually quite profitable. It's eliminating the mortgage that forces you to give up profitable opportunities. And it's also very, very risky. Rich Dad, Poor Dad, Robert Kiyosaki said, today I find many people struggling simply because they cling to old ideas. They resist change. Old ideas are the biggest liability. It's a liability because they fail to realize, well, that idea was an asset yesterday. Yesterday's gone, guys. And Douglas Andrew, Misfortune 101, he said, let me clarify why many Americans are remiss in arriving at the degree of financial independence they could otherwise obtain. while we do everything in our power to get tax deductions on our retirement contributions, hence the 401k, the Roth IRA 401k, we simultaneously eliminate one of the best deductions we have, our home mortgage interest. So mortgage moves that build wealth, put less money down, keep liquidity, invest the difference, let leverage work for your client, not against them. Retirement mortgage strategy, build equity now by paying your mortgage down, convert a retirement, I call it a retirement mortgage, so it'd be a reverse mortgage, but convert your mortgage into a reverse, which HUD changed, guys, in 2017. It's not as risky of a loan as it used to be. It's a much better loan now. It's now, in fact, they even changed the name to a HECM, a home equity conversion mortgage. So convert to I call it a retirement mortgage at 62, tax-free income, stay in your home, no monthly payments required. You can do that and help offset your Social Security, help offset pulling money out of your 401k, out of your retirement plans until you're 72. Refinance versus pay down when rates drop. A client who pays cash can't refinance. A client with a mortgage has options. So ultimately, a client, let's just say, and to really clarify the bottom one there, let's say that a client does pay cash, guys, and that's a great thing, right? But something happens in that client's life, and typically, like the clients I met with yesterday, they're doing a strategic refinance, and that's what I call refinances right now because rates are higher. They're doing a strategic refinance. That strategic refinance is done because they have to do it. They have a lien that's being placed on their property, and so they have to do this. And with a person that typically has to refinance, they've lost their job, something's happened, that a lot of times people come see us too late. They can't refinance. So I work with Olson Daines, one of the largest bankruptcy attorneys in the state of Oregon, right here in Oregon, right here in Salem. And they handle 1,200 bankruptcies a year. And so they send over a ton of clients. And I'm going to say that the majority of the clients we can't do anything with. They have to go bankrupt. And they have to do that because they've either lost income or something. So I want to say that putting cash in a house, trapping your cash in your house is the biggest liability that one has. It's the riskiest move because you can't get to that cash if you have to. Instead, the only way you can do that is by refinancing. Now, let's say that we go through another 2008, which we shouldn't do, but let's say that we do. I mean, right now, how many times do we see that, we've got a crisis in housing and home values are going to crash? I don't believe that's true, but how many times do we see that? Now, what happens is that if you put cash in your house and your house value drops, and then something happens and now you have to try to refinance. Sometimes you can't, and we found that through 2008. A lot of our clients couldn't, so then they had to sell. When you sell, you now lost your cash because the value is much less than what you bought it at. So it is a riskier move. The clients that put their money into a separate side account had a mortgage, put their money into a separate side account, and I'm just going to say not an investment, but a money market account, a liquid account like that, a high yield savings account making 3-4%, put their money there, they could weather the storm. They could weather 2008 if they lost their job. They didn't have to sell. I had one client one time come to me and say, "Well, I lost $30,000 this year in the stock market." My response was, "Did you sell? Did you sell your stock?" And he said, "No." I said, "Okay, you didn't lose $30,000. Your stock's worth less right now, but when you sell, you lost. But you still have the same amount of shares that you had before." So it's people's perceptions. So a retirement mortgage, again, this is what I call a reverse mortgage or a HECM mortgage. Available to homeowners 62. Now I'm going to say in Oregon, you can do them at 55. And so, and older with significant home equity. No required monthly mortgage payment. That's key. No required monthly mortgage payment. That helps to offset when they're taking Social Security or when they're pulling money out of their 401ks or their retirement accounts. It's a tool, guys, a tool. They stay in their home. Can provide tax-free income. So anytime that you're pulling money out of your home, that's tax-free. Reverse mortgage market projected to reach 2.71 billion in the year 2030. Senior home equity hits a record of 14.66 trillion in 2025. The opportunity is massive, and the agent who introduces this concept becomes the most trusted person in the room. Now, the agent who wins, the order taker is going to be, the one that writes the offer, right? Reacts to the client, thinks deal by deal, and gets replaced by the next app. And AI will replace those people. So the trusted agent guides the financial decision, educates and leads, thinks relationship by relationship, gets referrals for life. And I'm going to say is the one that says, hey, you can use any mortgage person that you want. But if you don't use my guy, I can't take responsibility for the way the transaction will lead or to the wealth that you'll create over time. I think that's an important statement. Experienced agent, 16 plus years, earned a median of 88.5 in income in 2025. And that was up from 78.9 the year before, according to NAR. So the ones that are getting the advisor role are up significantly, and they're the ones that have been in business a long time. So your action plan today would be learn one mortgage strategy this month and share it with a client. And there's a ton of mortgage strategies, guys. Mortgages are all about strategy. And how many times have you heard me say that if you follow me at all on social media? It's all about strategy. It's not about rate, not about program, not about any of those things anymore. A mortgage is all about strategy. Stop, please, for the love of everything. Stop letting your clients pay cash without having a real conversation first. That is so important, guys. You are killing your clients if you let them pay cash. I'm just telling you. It is the worst financial decision for most of America. Start asking your clients, do you have a plan for retirement beyond your savings? Partner with a mortgage advisor who can help you have these conversations with your clients. The agents who understand money are the ones clients will never stop referring. So the ones that can really help clients build wealth are gonna excel past AI. AI is getting smarter every single day, every single day. And the more stuff that we pump into AI, it continues to get smarter and smarter and smarter. The agents who thrive won't be the ones who write the fastest offer. They'll be the ones clients trust with their financial future. So that is the class. Stop my share. All right. Okay, guys, that is the class today. What information or what questions do you guys have for me? Or do you guys have any? Let's see. Yeah, I can get you a copy of the slides, Mary. You guys have any questions? Did you guys enjoy the class? You're welcome, Leah. What did you guys get out of the class? I guess would be my question. I really can't give examples of how everybody's using AI. Um, but I did give examples of how I'm using AI. So AI is going to be, I think, really think of it this way. AI is your assistant. I mean, it's a tool. Those that use AI get comfortable with AI and then keep building their AI will excel. I mean, it's a tool. It's kind of like the whole kind of like Iron Man. I mean, you look at it, I think whenever I think of AI, I always think of Iron Man and the way that he would do things within his house and stuff. But anyway, um, I agree. AI won't replace us, um, but it's something that it will replace some people. Some jobs, some people. But anyway,
I've been talking with agents about using AI
yeah,
just to recognize how buyers are searching for agents and they are searching on AI for the best agent in Salem or the best agent for luxury homes or the best agent for manufactured, whatever it is. But if you think like your client and search for the best real estate agent, and then if you scroll all the way to the bottom, you can see where those sources came from. And then you can go and just make sure that you are on every single one of those pages. Like one of them is called Rate Agent or Expert Realty or something. There's all these little sites that I've never even heard of. But if you just go on there and make yourself a presence on those sites, you're going to pop up as the best agent in South Salem or wherever it is you want to specialize. So kind of go at it backwards, I think is a good way to think.
yeah, and I mean, I agree with that. And the other thing is look at Reddit. So be on Reddit. Create
Yeah,
your
Reddit's
profile
huge.
create your profile on Reddit. Have a YouTube channel. Get Google reviews. Do all these things that we've been talking about for years. Because AI searches all of those things, and your client searches all of those things. They they search your Google reviews, they search your website, they search Reddit, and they look at everybody's responses. So so being part of all those things, just ask AI. How can I use you?
Exactly. What can you do to help me with my business? And it will
Yeah, I
tell you.
mean, so yeah. So all right. So I don't think there's any questions. Doesn't look like there's any real questions. Just, Roxanne and others, just get comfortable with AI, really, and and study. I mean, I don't know if you guys know this or not, but YouTube now is the number one search engine in the world. Not Google anymore, YouTube. And so, anytime that I need to do anything, I mean, whether if it's AI related, um, whatever, I go to YouTube and I start looking at what people have said on YouTube. I look at their videos, and that I see how many times their videos have been watched. There's a wealth of knowledge on YouTube, and that's why people have started going to YouTube before Google. And in fact, AI is getting searched. um, there was a slide I was going to add that I didn't add, and I don't know that I can find this picture fast enough to make sure. Let me just see if I can find this picture fast enough here, guys. Sorry. I totally was going to add this slide and I forgot. Of course, now that I'm under pressure, I won't find it. I have to remember which class I was in. It's amazing how many pictures we take throughout a period of time, right? Well, anyway, what the class was about AI and how fast people adopted Google, how fast they adopted YouTube and others. Yeah, I'm sorry, I'm not finding it here real quick. So how fast they adopted those platforms. And then it went to ChatGPT and how fast ChatGPT and AI was adopted. And literally it was within a month or two, it had more adoption for the whole world than Google did or YouTube did, and any of those search engines. Those search engines took a couple of years to get to the same amount of numbers that AI did. So AI, everybody's on AI. I mean, not everybody, but almost everybody's on AI. And so yeah, get on it, play with it, use it. Anyway, cool. I hope that you guys found value. All
Okay.
right. If you
Thanks,
have any
Walt.
questions, reach out.
Thank you. It was fun.
Guys.